Good. All right. So thanks for everybody for joining us for this webinar on a Thursday evening at 8 p.m. So this is called Toronto First-Time Condo Buyers. This is the first type of webinar that Carmelo and I have done, and it's focused towards those that want to get into Toronto's real estate market. And the reason why we decided to focus on condos is because condos are the entry point for most first-time buyers, just because of affordability, and also it's the largest chunk of our market in the GTA. I mean, Toronto's one of the top condo markets in the world. I'm going to talk a little bit about myself. Brief intro. My name is Zhvanetskiy. I'm a realtor of REMAX Condos Plus in Toronto. I'm based out of their Bay and Bloor office. I've been a real estate investor since 2013, and that's how I first developed an interest towards real estate. Spent over a decade in Toronto's condominium industry as well. I used to be the vice president of a service provider that tailored exclusively to condominiums, and for that reason, I've probably been inside every Toronto condo at some point, whether it's to talk to a client, do a walk around, do a risk assessment. In fact, I've participated in conducting over 65 condominium risk assessments. I have a deep understanding of Toronto's condo market, and in 2022, I was in the top 1% in condo sales from over 70,000 TREB members, and probably 2023 as well. So yeah, that's me. And Carmelo posted my Instagram also in the chat. It's at alexz.realtor. And let me talk a little bit about why condos. So I started already kind of talking about this topic, but Toronto is one of the top condo markets globally. We have excessively high rate of condos per capita, and that's the type of property that's being built the most these days, just because we don't have so much room to go out. So we're going up. It's the lowest price point. For most, it's the first type of home ownership, but for many, it's not their forever home. It's just a way to get into the market, start building equity, and then upgrading to their forever home in a few years. So I believe that most people that own condos own them for about probably between 5 to 10 years, and then either keep it as an investment or sell it and purchase a larger property. Overall, there's less maintenance in condos, so you're paying maintenance fees. That's measured as a dollar figure per square foot, and the building is pretty much looked after on its own. You're only responsible for what's inside your walls. Rents in 2022 went up about 30%, and again in 2023 they're even higher. Like this graph here shows average one-bedroom apartment rent at $2,481. This was in Q3 of 2022. Q3 of 2023, I would say this number is around the $2,650 mark. So there's a lot of strain on our real estate. There's a lot of immigration and people migrating into Toronto, Greater Toronto area. I'm sure you've seen it all over the news, bidding wars for rentals. That's why it's so important to get into home ownership if you can, because rents are just going to continue to go up higher. And when you get into home ownership, you're building equity. You're also locking in that carrying cost. And then as interest rates do become less than what they are now, we are in a higher interest rate environment, then it's going to become even more affordable. So I encourage anybody who can to invest in real estate. And there's, like I mentioned, many options available throughout the Greater Toronto area, and they're tailored to different types of lifestyles. There's buildings that are pet free. There's buildings that are for people over 55 years old. There's buildings that are pet friendly, where you can have as many dogs as you want. So it's really about finding the condo that is the right fit for you. I don't believe that all condos are built the same. There's different tiers of buildings, different tiers of builders as well. So you want to make sure that you're investing in a reputable community that tailors your fit. The last thing you want to do is buy a condo, move in with your cat or your dog, and then find out it's a pet-free building, and now you are stuck and not kind of sure what to do with that. So as I mentioned, understanding condos, you own your unit. So you own your unit and a proportion of the common elements, which is measured as a dollar figure per square foot. Right now in the GTA, average maintenance fees are probably about 75-80 cents a square foot. And the buildings and community rules, it's something important to understand, like I mentioned before about pets, but also things like short-term rentals, for example. So there are some buildings that permit short-term rentals. They are probably like they are heavily in the minority, probably in about the 10% to 15% of buildings. But for that reason, there's a really high concentration of short-term rentals in those buildings. If anybody's ever heard of ICE condos, for example, those buildings are notorious for short-term rentals, and also having parties and people throwing chairs onto the garden or off their balcony and all kinds of crazy things like that. So it might be good as an investment if that's what you're looking to do. But if you are looking to reside in your unit, you may not want to live in a building that permits short-term rentals. And also there are buildings that are smoke-free. So if you're a smoker, you can't even smoke on your balcony, for example. So these are all things to kind of keep in mind. So some other things you want to consider when you're selecting a condo, maintenance fees. So make sure that the building has the amenities that you're going to use. So a lot of times I talk to clients and they're really gung-ho about having amenities. They want to have a pool, they want to have a gym. And then when I talk to them about a year later, they've been in that pool once and they kept their Good Life membership. So these amenities cost you money. Make sure that you go into buildings that have amenities that you actually are truly believing you're going to use. Otherwise, this might not be something that makes sense for you. So for example, having a concierge in your lobby is great for somebody to accept your parcels, open the door for a safer feel of community. But there are also buildings that don't have concierge. And because of that, maintenance fees are lower because, for example, a 24/7 security contract is over $250,000 a year. So there's other solutions for having like a snaily mailbox locker, for example, where the courier can put your mail. Other solutions like virtual concierge, maybe a building that doesn't have any concierge. So like really think about it. Is this something you're going to value? Is this something that's going to add value to your life? Because whether you use it or not, if you live in that building, you're going to be paying for those amenities. There are some expenses that you can't avoid, things like having cleaners or property management or building contractors, but generally maintenance fees do go up about 2 to 3% a year. That's normal with the rate of inflation, maybe even a little bit higher now. But again, it's important to make sure that you will actually be using these amenities, because if you go into a building that has less amenities, that generally means less maintenance fees. So a little bit about myself again, that's my contact information there. If you want to scan that QR code, they'll take you to my link tree. If you want to connect on Instagram, it's at alexz.realtor. So now let's talk about the numbers. Carmelo.
Well said, Alex. Hi, everyone. My name is Carmelo Buttice. I'm a mortgage agent, and I've been doing mortgages for over 20 plus years. Alex, you want to go back a slide a bit for a second?
Sorry about that.
That's all right. I began my career actually as a mortgage underwriter. For those who don't know, the position as a mortgage underwriter, they're the person at the bank that's reviewing your application and making the decision whether they're going to approve you for the financing or not. So the first thing I learned in my career is how the banks think and what they look for to approve you for a mortgage. Over the 20 plus years, I worked for the big banks. I worked for smaller alternative lenders. So I'm very diverse in understanding with all the different mortgage lenders that are out there. And now I'm independent. I work for you. I have no loyalty to any bank. It's really who's got the best product. I always say it this week for the financing. And I have access to over 59 different lenders between the big banks, monoline lenders, credit unions, trust companies. There's a lot more variety out there than just the big five.
Right. So there's, 59 different lenders is a lot of different lenders. I know we used to have a little game, Carmelo, where it would be like, can you name, 6 banks in 30 seconds or something like that?
Most people can't name more than 6 banks in 10 seconds.
I can't even think of that. I can name maybe 3. So, yeah.
So when you're looking at buying a property, the first thing you need to do is you need to get it pre-approved, right? If you're looking for a condo or a home, pre-approval is the first thing you got to do. And there's a lot of value with getting a pre-approval. Right, Alex?
That's right. I mean, it gives you an understanding of, first of all, what can you afford? And a lot of times, actually, believe it or not, I meet people that are looking to buy a property, but they haven't gotten a pre-approval. They don't know what they can afford. They're just kind of like estimating it. I mean, I've even seen people that never got a pre-approval put an offer unconditional on financing on properties, and that's just, I'm not even going to get to that. That can be disaster.
Well, yeah, there's a lot of benefits with getting a pre-approval, right? Because you get to know what you can actually afford, what your budget is. right? And as a buyer, you actually become more desirable to the seller because they're going to be like, have you, the seller's agent may ask Alex or your agent, have you been pre-approved? And the answer when they hear yes, like, oh, this person's already gone to the bank, right? And when you're looking for someone to work with, more people are going to be more willing to work with you because they're like, oh, this person's already done their homework. They know what their budget is. They're not, going to be showing them homes that are outside their budget.
For sure. I mean, unfortunately, I find that a lot of agents, if the client has not, or the person has not been pre-approved for a mortgage, they won't even work with them. They're going to be like, okay, go get pre-approved first. Let's see what we're working with. And then we can go look at properties, do showings, all of that. Because like, if you don't have the pre-approval, if you can't afford the property, like there's really no point to be shopping for it.
Yeah. But the last thing you want to do is go find a house or a condo that you want to buy, and you're short $40,000 in financing to get it.
Yeah, 100%.
So really, now what do the banks look for to approve you and to finance a property? Well, there's really 4 things the banks look at when approving somebody to buy a property. The first thing is the property you're buying a marketable property. So if you're buying in the GTA, I'm going to say 99.999% of the properties are marketable. Marketable meaning you turn the key, it's turnkey ready. It can be dated. It's dated from the the 80s and 90s. That's okay. But it's got to be livable. If there was just a fire in it and the property hasn't been repaired, well, it's not really a marketable property. Or if the kitchen's been torn apart and there's no kitchen, you can't really live in it right away. You got to renovate it.
I like how you said 400 square feet here, because there are a lot of condos that I see now, especially new construction. There's units in the 300. I mean, I've seen units that were in the high 200s.
Yeah.
I mean, it's not much to live in, but.
Well, this is where, again, marketable condos, again, the marketable properties, again, it's got to be in an urban area. It's got to be in good condition. Again, I put 400 square feet as the size because I want you to have access to the majority of banks and lenders that are out there. There's only a very, very, very small handful of banks, because I've done 1 or 2, condo purchases under 400 square feet that will finance, a studio that's really, really small. Right. And the key thing is you also want to know that get the details when it comes to the stash certificate, because the stash certificate tells a lot of the health and the financial stability of the property. Is it being managed well? Does it have good reserve funds? Or is there poor management spending their money on, not budgeting properly for future expenses?
Now, correct me if I'm wrong, Carmelo, but when a lender approves you for a mortgage, yeah, they're approving you as a buyer, but more importantly, they're approving the property that you're buying on.
Yes,
That's insurance.
That is their security. That is a collateral. If you do not make your payments, now the banks are not in the business of taking properties. They don't want to take the property. It's bad PR. But again, they want to know the property they're securing the financing on is a good property.
Yeah. It's and status certificate, so important. Like I always encourage my clients to always include a status certificate condition. I mean, for me, when I do an offer on a condo, that's just a standard, because that's the minutes from the last annual general meeting. That's the engineer's report for the reserve fund study, where engineers will attend the building every 3 years, and they actually do a full report and a maintenance schedule that tells the building, okay, this is how much money you have to be putting away for wear and tear. Like we see that your boiler maybe has 10 years left in it. You're going to have to replace the boiler in 10 years. This is how much money you have to allocate to that. If there's a special assessment happening, that can create a huge challenge for somebody that's looking to buy a unit in that building, because a special assessment is basically the condo corp is saying that we don't have enough funds in our reserve fund to fund whatever repair is necessary. We're now going back to unit owners and saying that, you have to pay. I mean, I've seen special assessments that were as little as $500 to special assessments that could be $500 a month for 2 years.
That's exactly it, right? So that's the marketability of the property. If the property's got like this offset maintenance fees of over $1,000 per month because of a special assessment, well, financially that building's not that great.
For sure.
So the next thing the banks look for is, are you working and can you verify your income? Banks have changed a lot over the last 20 plus years. especially when it comes to employment. Their key thing is, are you employed? Or whether you're full-time salary, there's a lot of full-time hourly workers out there. It could be, there's a lot of permanent full-time employments out there. Banks, people get bonuses or people get, commission with their income. The banks will use that if you've been getting it consistently for at least 2 years. Over the last 3 years with the pandemic, a lot of people have changed jobs and became doing the same line of work, but now they're self-employed. That's okay. And again, like the banks have also a little bit even more lenient now, because if you have children under the age of 13, they will use those child tax credits and the benefits you receive as income to help you qualify for a mortgage. So the banks, I hear it a lot, the banks are strict. No, the banks are actually expanding their guidelines in how they look at things. It's where do you fit? Where do we fit? Right?
So,
and which bankers will do these certain things, but not all banks are alike.
and I guess that's where well, for sure. I mean, I know from experience that your access to these different types of lenders really comes in, because people have different types of income. Like, what about somebody that maybe they have a full-time job and then on the weekends they're, I don't know, driving Uber or, I don't know, working at the gas station just for extra money?
So gas station, because it's an hourly wage, that they're going to be more acceptable to that if it's permanent part-time. Uber, because again, if they've been doing it for 3 months, no, there's really no history. The most common example I have, Alex, is have someone who used to work at Rogers as an employee doing IT. Now they're self-employed and their contract is to Rogers. Where the banks are like looking at, okay, the same person works for Rogers for a long period of time. Now they're self-employed. Yes, they're okay with it.
Right. Makes sense.
Right.
So I guess if it's like a standard T4 type of job where you're getting just a paycheck every 2 weeks, you probably just have to be done your probation. Whereas in, like, if you're a contractor or self-employed, you have to show history that this is how much you're doing, right?
Ironically, again, that probation again is something, again, it's a misconception. A lot of people have changed jobs, and Alex, as long as you're in the same line of work, and most of the time people are changing for higher pay, they'll give you the approval, but as long as the closing is after your probationary period. So you don't have to wait till after your probation to purchase the property.
Wow.
Right? If you have 3 months probation, you're 2 months in already, you can make the offer, because it's not like you're necessarily going to be closing in 30 days.
Huh. Yeah, makes sense.
So again, the banks, again, they're actually a little bit more lenient. It's really, every bank has their own requirements. The third thing the banks look for is your credit history. They're not only looking at your credit scores, they look at the whole package, the history. Now, they do like to see credit scores over 680. I've helped people get financing with, 679, 670, but they look at the full deal. And when they look at your credit, they not just look at the number, they look at your history. How many accounts do you have? They prefer to have that you have at least 2 accounts, and I'll call them accounts because it could be credit cards, it could be lines of credits, it could be loans, that have at least a limited balance or limit of $2,000. They want to know that you made all your payments on time, right? And the key thing is whether you carry a balance or you pay in full, as long as you make the minimum payments on the due date. That's what really matters. You pay on time. Cell phones nowadays are on credit reports. So I've gone through it with changing cell phone providers. Missed, all of a sudden there's a fee for changing, and all of a sudden it's like, oh, you get a bill that shows up. Whatever you have, again, keep your payments with your cell phones up to date, even though they may be in the wrong. Don't let that impact your credit score.
And monitor your credit score. I mean, use apps like Credit Karma or Borrowwell to see what's happening. Like, can I share a little example here?
100%, Alex.
I had a credit card from a bank, and it had a balance on it, and I paid off that balance, but there was like, I don't know, like $1 left on it or something like that. So because I monitor my credit score, I got an email saying your credit score like declined. I looked at my credit report, it declined significantly because of that $1 on a credit card. Had I not known about that, I mean, I would have only found out that my credit score was impacted the next time I go somewhere and I'm trying to apply for credit. whether it's a credit card or to finance a car or for a mortgage or whatever, right? So because I knew about it, I was able to pay that off, and then like within 2 weeks, my credit score went back to what it was before.
One tip when it comes to credit, don't cancel any cards. One reason is, again, a scenario like Alex you brought up. Again, I've seen those scenarios happen more when people cancel credit cards, and then credit's all about history. I have credit cards that my first credit card that I still have from when I got out of university. I don't use it anymore, but every few years when the credit card expires, I get a new one, and I just actually use it just once per year to kind of keep it active. What it shows is it just shows I've had this credit card for over 20 plus years, and I've never missed a payment. So credit reports don't show your daily activity or your monthly activity. It just shows when you receive it, have you ever missed a payment, and what's the standing right now. So when it comes to credit, you could trick the system and beat it and get an inflated credit score by not canceling credit cards.
Excellent.
The last thing you need when it comes to buying a property is, I hear it a lot, Carmelo, I got $50,000 for down payment. Next question is, well, how much do you have set aside for closing costs? You need money for both down payment and closing costs. Now, you could buy a property with as little as 5% down payment if you're buying the property for $500,000 or less. There's one big misunderstanding. If you're buying for more than $500,000, I hear it a lot that people think that they have to put 10% down, which is not true. It's a ladder. So on the first $500,000, you're still allowed to put 5%, which is $25,000. If, for example, you want to buy for $600,000, if I'm buying for $600,000, well, you only got to put 10% down payment on that difference between the $500,000 and $600,000. So you only got to put an extra $10,000 on top of that 25. So your down payment would only be $35,000 versus $60,000 if you're buying a $600,000 property.
Nice.
Again, closing costs, all the banks across the board, doesn't matter where you're buying, they just kind of, whether you're a first-time buyer, you're a second-time buyer, they know you want to have money to cover closing costs. As a first-time buyer, you will get that land transfer tax credit. But again, the banks don't really differentiate that. They want to know you have an extra 1.5% of the purchase price for closing costs. That's to cover the lawyers. That's to cover if there's, if your land transfer tax credit doesn't cover the full amount, to cover that. And most importantly, the banks want to know you have the extra money to turn on the lights, right? And all utilities are going to be established. Now, the savings for that, there's so many accounts. You have the money in the RSPs, tax-free savings accounts, high interest savings accounts with interest rates being high. I see a lot of promotions for these high interest savings accounts being at like 5% nowadays. And now there's a new introduced this year, first homeowner savings account. Alex, this is actually a real cool product.
Okay.
Because it's kind of that combination of RRSP and TFSA. You're allowed to put $8,000 every year, up to a total of $40,000. The money you put into it, Alex, you could kind of deduct it from when you do your taxes and get a refund, like an RSP. The benefit is any interest or capital gains you have in it is tax-free, like a TFSA. And when you take it out, you do not have to pay it back like an RRSP.
Nice.
So another cool thing about it is you could put money in an RSP, and if you have the extra money, you could also put money in that first home savings account and get a massive refund.
Nice.
And now you can put them in both accounts.
Very nice.
So those are the 4 things the bank look for. If you have these 4 things, you're gonna get approval.
Yeah, and one of the things, I mean, like with the down payment. So just to put into perspective, if you're going to be buying a condo for $600,000, which is quite attainable right now, that means that what you need $25,000 plus.
You need $35,000 for down payment.
Yeah.
And you need an extra $9,000 to cover closing costs. And you're not going to be using all that because as a first-time buyer, you're going to get that land transfer tax credit.
Yep.
Again, another purpose of that is the banks want to know you have money to turn on the utilities and you have a little bit in your bank account.
Very nice. So is that the last slide?
Yes, it is.
It is the last slide. So I'm going to start.